Auctions come and go, but this one caught my eye, Marvin. I think a lot of people are wondering about this, the more intermediate, shorter part of the curve. But in our Bloomberg story, they pointed out that the 7 Treasury auctions so far this year have all come in better than forecast, more demand. What's going on?
Yeah, absolutely. And, we had the 2-year auction earlier this week, and we wound up with similar results where there remains fairly strong demand for U.S. Treasury securities. So, I do think that peak rates and this recession discussion and, from a portfolio positioning perspective, owning bonds and particularly owning Treasuries as either a hedge against recession and or providing income if, in fact, we wind up, let's say, with a soft landing and rates compress significantly, locking in these yields is something that ultimately is proving attractive to a lot of investors who might have been short a lot of these securities after the volatility and the challenging world we had last year, for sure.
So when you look at the yield curve, which is in essence what we're doing here, because we've got the 2-year note at 4.12, the 5-year 3.54, you get to the 10-year at 3.44, and then you got to kink back up. The 30 years at about 3.6. What's the yield curve telling us now? People have been wondering for the longest time if it was signaling recession. Is this a technical move? The shape of the yield curve, is there a message here?
I still do think that it is signaling a recession. Interestingly, as we start thinking about when the Fed's going to start cutting rates, the real discussion is when does the curve reinvert? When does it get back towards neutral? When does it possibly get positive? That would, of course, be driven by lower yields around the 2-year part of the curve as the Fed starts to cut. The fact that it's holding in there, despite all these recession discussions, I think is interesting in that while there's widespread belief that cuts are coming, we can't price them yet. There's still uncertainty at the short end as to when those cuts might start making their way in the market, even though a lot of risk assets are taking this pivot, if you will, thinking about how rates look at the end of this year, how rates look in the middle of next year as a fairly positive sign. I think the rates market is a little bit more hesitant to embrace that view.
I'm wondering, Marvin, if you can remember a time when it's been so difficult to read the data, because when you look at it, you can use it really to either make a case for getting defensive or for getting aggressive. Which is it?
Yeah, you know what? We certainly are transitioning into a data by data type of environment. So every data point counts. And, for the most part, markets are grabbing the data points which support the view that they have. I don't think that it's as clear cut in terms of just saying the data is deteriorating to a point where the Fed is going to have to cut rates. Some of the most important data points are still unacceptable. Inflation is better, but it's still too high. And certainly the discussion that you had in the earlier segment about the jobs market remains one of the key parts of the inflation discussion that the Fed still is not comfortable with and really hasn't shown the degree of improvement that maybe some of the survey data and to a lesser extent some of the hard data as we get into this year weakening to the degree that really gets the Fed in a position to want to cut aggressively.